Welcome back to Power Lunch. Major averages trading just off the worst levels of the day and wiping out most of yesterday's gains. With another Fed decision ahead next week, will there be more choppiness ahead? David Bianco is CIO at DWS Group Americas, and Ron Insana is CNBC senior analyst and commentator, as well as chief market strategist at Dynasty Financial Partners. Gentlemen, welcome. David, let me begin with you.
Hello.
You think the fall is going to be choppy and a little unsettled, in part because of competition from higher interest rate bearing instruments.
That's the main reason. The bond market, not just these overnight rates, but increasingly when you look a little further out the curve, even intermediate duration, credit, munis, they're offering a 5, 6, in some cases with a little credit risk, 7% return. I just don't think the S&P 500 is going to do better than that, not just over the rest of the year, but even to the end of next year. I think it's a good time to put more money than usual in fixed income and see how things play out.
Yeah, you've got a sort of a range-bound S&P forecast of 4,000 to 4,800 or something like that?
That's right. I am the regional CIO for DWS, and I look at all asset classes. We're always invested across all of the asset classes. I do head active equities. I've been an equity strategist for a long time. I tend to favor equities. I just think right now it's not a Goldilocks for profits. We do expect profits to grow next year, mostly from tech, but a lot of industries are going to be challenged to do more than 5% earnings growth. And with these interest rates, I don't think you get any PE expansion.
Ron, how does what David says sit with you?
Similar, but not the same. I would imagine that for the remainder of this year, we're going to chop around. It's something I think I've maintained for the last couple of months that, going into September in particular, and given the kind of event risks that exist around the world and some of the credit concerns we may have going into early 24, that's a possibility that we chop for a while. I think ultimately, if the Fed does start to cut rates in 2024, you're going to get a break for the market, and that turns into a bit of a tailwind instead of a headwind, assuming inflation cooperates. And we've seen a bit of an uptick, obviously, in energy prices and shelter costs and things like that. But I think choppy until we, kind of get out of this typical window where markets are under pressure. I'm not as bearish on next year as David might be.
Let's talk a little bit more about the Fed and your thought there. What would cause the Fed to start to lower interest rates next year? Does it mean a major slowdown in the labor markets? Does it mean a major slowdown in GDP growth? What would cause it, particularly in light of the fact that inflation seems pesky?
Yeah, I think, Tyler, at the end of the day, there'll be an event of some sort, whether it's, commercial real estate putting pressure on financial institutions. There's $270 billion of exposure on just small and medium-sized banks. There's 1.2 to 1.4 trillion worth of commercial real estate debt that's going to get rolled over the next year and a half. So that could be a trouble spot. If China slows down materially and threatens global growth and domestic growth, and the fact that just real interest rates are too high relative to inflation could start, and Jay Powell himself has admitted this, could start the Fed in a process of towards bringing down interest rates. Also, fourth year of a presidential cycle, irrespective of one's politics, is typically the second best year of that 4-year cycle, this year being the best. So I think there's maybe a little more tailwind coming, even though obviously there are some event risk issues out there for the markets in the next several months.